Hello and welcome to the Harwood Report for August 13th, 2017. I am Keith Harwood, author of the Harwood Report and founder of Trade Academy. Let's go through the disclosures as always. To start, all services and content on this video are provided for educational and information purposes only and are not intended as legal or financial advice. Trade Academy is not an investment advisor, is not registered with the United States SEC, is not registered with FINRA. Anything I'm talking about here is for informational purposes. It is not a trade recommendation. If you want to put on a trade, you need to do your own due diligence. This will hopefully give you some information as opposed to the framework that I'm working with this week. But that's the framework I'm working with. I want you guys to use it as an educational tool and build your own framework as well. Highlights. Normal. We'll start with the same four big indices: the S&Ps, the Nasdaq, the Russell, and the Dow Jones Industrial Average. I'm going to talk a little bit about volatility this week because we had such an incredible move in the VIX and some of the related products, VXX ETF as an example. Then we'll go over to the rates, forex, commodities section. Again, I'm going to look at USD JPY, talk a little bit about what we saw last week, how that impacted gold, where the miners sit, because that's been interesting coming into this week, and TLT, the bond ETF. Finally, couple of sectors that I think are interesting setups this week: EWI, which is South Korea, and XLF, which are the financials. So let's start with the equity indices. SPY. Last week I highlighted that just basically this chop was nothing that I was really that excited about trading. And so I really didn't look that much at SPY as a trading vehicle, but more as an indicator vehicle. We had an interesting attempt at this breakout to the upside here on Tuesday. We had a little bit of a fade into Wednesday, and then we started talking about escalating tensions with North Korea. Fire and fury, all of that. That created our big break in the S&P. We got below the little lower end of this range here, and the mid 245, 245.68, I think was a low there, and dropped just below the 50-day moving average. Closed below the 50-day moving average 2 days in a row. This right now is going to be an important level to see how we behave this week. If we do what we did in the past when we've had these kind of drops, let's look at the last few months. In March, we had a drop like this, a little bit of chop, and then really this one just chopped sideways. We had a little rally out of it, but nothing crazy until we got about a month later. Here, we had a basically immediate turnaround, that drop and then run. These ones have just been more chop. I expect this to either have some bad follow through. Let's push down to the 100-day moving average because there's some negativity to the market, or a chop here in this range between maybe 244 and up to 246, 247. I don't expect to see a new 52-week high in the next week or two unless we completely resolve the issues in North Korea without any sort of military action. I don't expect that to be likely. But that's just the general framework here I'm working with, is if we get back towards the 246 level, that's probably the high end of the range for me. And this intermediate week, 246, maybe 246.5, that's where I'd look to see if I can actually fade that move as opposed to playing for a breakout. On the downside, we just have to get below Thursday's low of 243.70, and then I think we could see that move back down towards the 100-day moving average, and then we regroup and decide what we're going to do next at that key point, which also happens to kind of coincide here with the lows back from 4th of July-ish range. But for me, again, I'm not necessarily looking to put on a trade in SPY here. I'm using this as an indicator for some of the other sectors. The Qs, same kind of setup here. We had a little bit more volatility into that, but yeah, we had a break. Bounced back. We held above the 50-day moving average on Friday there, so the Qs had a little bit better recovery than S&P in terms of the big technical level. But we've actually more recently tested the 100-day moving average. So again, not really looking at anything major in the tech sector this week, so I'm not going to spend a lot of time talking about it. A lot of this, what I said on S&P applies to the Nasdaq there. IWM is a little bit different. So the Russell 2000 ETF, this was sort of your relative weak sector coming into last week already. So when we broke on Thursday, we got down to the 200-day moving average. A close below the 200-day moving average is very bearish because it's got a very big, that's a very big level for many trading systems. Given how close we are here, this is actually going to be a bigger focus for me than S&Ps and Nasdaq. This will either hold, in which case we're going back to 140 in relatively quick order, or fail, and then we've got very little obvious support right below, maybe here down at around 132. But this could get ugly fast if we don't hold the 200-day moving average. So options have come up a lot in price. So if you're looking to play the rally, I'm thinking maybe a short put spread. If you're looking to play for the break, it would be a long put. That's a tough situation to be in, where you're sitting there talking about generally, you're going to want to have a long put around this 134, 135 level. If you're doing anything at all on the bullish side, you'd sell that and you'd buy a put down here and maybe sell the 136 or 137 puts. Hope that premium goes to zero. But if you're looking for the bearish play, if you're along something in the 134 range and we get that breakdown to 132, that should be pretty good. Just give you a little bit on the pricing there. If you go to IWM, you can see the August 134 puts for this week, around 55 cents. That's not cheap. But if you get a move down to 132, we have 3 or 4 to 1 R&R there. So that's not awful. It's not, there's no slam dunk trade to me in this ETF. Finally, the Dow Jones. So this has been the strong performer, and as a result, it has not crossed as many key levels. It has crossed the 10-day moving average, and that is it. If the Russell breaks, if S&Ps break, if the Nasdaq breaks, this is going to play some catch-up, actually, and I think that this could have a little bit more of an aggressive move down all the way to the 100-day moving average. We know IWM was the weakest. Sometimes when you've got a real liquidation in the market, the strongest are the ones that get hit the hardest because people are looking for risk reduction. Clearly, the market participants are along the Dow Jones Industrial Average relative to the others because this has been the strong performer. They tend to buy their stronger sectors. So if you look at the option volatility here, because it has part of the market, the volatility has come up. It's around 11%. We've seen as high as, around 13% in April. In comparison, IWM is roughly the same sort of level. It's 16.5 versus that high of 19. So it's not like they're giving any of these sector volatilities away. You can see SPY here, and then finally the Nasdaq. There's no clear, this is a cheap vol, this is expensive. Nasdaq might be the most expensive, but when you look at the Dow Jones here, if you wanted to play for a break this week, I think this is where I would look for it. Maybe, we got to go into the August 18th. You could look in the August 18th as long as this vol premium doesn't stay too high there, and look towards, if you're looking for that move down towards, say, 215 as an intermediate target with a 212 eventual target. That's a multiple standard deviation move. Just keep that in mind. Then we'd be looking at maybe buying these 216s or 215s for that kind of play. I'm not necessarily looking to do anything with Dow Jones. If we think that this is what's going to happen, I will probably look towards individual names that have been outperformers and have a lot of downside to go. But actually, my focus is stuff that we'll talk about more in the commodity and sector ETF stuff that at the end of the report. I wanted to quickly go through volatility. This was actually, I want to start with the actual VIX volatility index. What did I do here? Switch this over. So if we look at the actual VIX, this was a big spike, very similar to what we saw in May on the spike, and then that faded. The Friday move, there was a little more short covering of volatility and then break. This was a little bit shocking, as we saw the market wasn't really getting hit at all. In fact, it was rallying while the VIX was rallying, as people were just continuing to reduce their short Vega exposure. So basically, as the market was rallying a little bit in the morning, people were continuing to buy option premium to take off that tail risk. Into the end of the day, the market came off a little bit because of this vol bid, I believe, and some of the correlations that result. So the VIX is staying relatively elevated here. If the VIX can trade below Friday's low level, which was 14.5, then I think you can really start counting on that. So those support levels starting to kick in for the equity indices. S&Ps are going to, bounce off the 50-day moving average. The Dow Jones is going to go back to a leader. IWM, the Russell, bouncing off the 200-day moving average. So you've got a lot of bullish setups in that case. And so I think you've got those little minor bullish setups, but again, that's like a short put spread play because of where vol premium is overall. This would obviously, as this gets below 14.5%, that vol premium is coming down, but it still has a long ways down here, maybe sub 12. The play there could be in VXX because of the structure of this ETF. You can see that it basically has a just terrible decay factor because of the constant contango and the rolling that needs to happen. So if this starts to come down, you saw that it closed around 1365 on Friday. You could very easily see this back to 12 or even 11 by the end of the week. The problem that you've got with that is where volatility is on the VIX. So even if we look at, well, first we can start with VIX. We look at the volatility. This is extraordinary volatility of the volatility index. Basically, what this means is that they're expecting large moves in the volatility index, not just in the underlying indices. Similar case for VXX. You can see that big implied volatility, and that's a big premium to the realized volatility. So I don't necessarily want to be buying puts here. If I look at the VIX options, and I want to play for that move back towards 12, I don't really want to do it on an August 16th expiration. It's too quick. August 23rd, that volatility is pretty high. You don't really get paid for it buying a put. August 14th. The August 14 puts are about 55. If you're playing for move to 12, you're barely making any money on that. If you look into the put spreads, there's maybe something there because you can sell the 12 put against it and make it $1.10. But again, now you're only at 2-to-1 R&R. That's not great relative to what we were seeing in some of the equity indices. So until the vol of vol comes down, until these levels start to normalize again, I'm not going to look to buy anything with long options here. The defined risk trade that you may want to look towards would be selling a call spread, but there's a massive call skew. It's really hard to find a structure here that is a slam dunk. Short delta is sort of that general desire for me. I would like to have a little bit of short delta here under the expectation that vol comes back down, but only if the vol of vol comes down. So if people start to sell options here, and then these start to get back down towards maybe $1 on the 14 put, then I might get a little bit more interested in either that put or that put spread we were talking about earlier. Continuing on here, let's go to the stuff that actually has more interesting trades for me. So the first one is USD JPY. A little update on what we saw last week. Last week we were sitting right here, just below the 10-day moving average, and I said that if the market closed above the 10-day moving average, I'd like to start looking at puts for GLD. Well, on Monday, the close was 110.75. The 10-day moving average was still 110.78, closed just below. Tuesday, we started to show some weakness in the dollar-yen. Wednesday got a little worse. Thursday got much worse. Friday, we had the basically the break and then close really close to the Thursday close. So Thursday's close was 109.22. Friday was 109.19. Still a lower high, a lower low breaking market. Getting a little bit away from the 10-day moving average. It's driving gold higher. I mean, this is all the fear trade, the risk-off trade that we're seeing in the markets as a result of the situation in North Korea. That's why you see in GLD, the gold ETF, that we are trading right up against those previous highs made in April and June. It's a big resistance level. If we clear through here at around, what was the high there? I think it was 120, so 123.31, 123.07, 123.03. So, really getting through 123 into that 123.30, 123.40 range, that could start to get a little bit more fireworks going. We've had a big move already, of course. We jumped from 120-ish to 123 already. I still think, though, that now people are getting excited about gold, and that's what makes gold interesting, is when people are saying, I do need to have a little bit of gold in my portfolio. I can't just stay away from gold. That puts some passive money back into gold, and that's what helps create a little bit more of a bid. We've had some active money going into gold. You got to start seeing some of those passive investors, the ones that are buying just ETFs in their 401k, saying, you know what, I do need to allocate into commodities. And if their advisors are telling them to allocate some into gold, that's great. That puts a little bit of an underlying natural bid to gold. and helps us get through some of these resistance levels. That's what makes me most excited this week about GDX. So the gold miners have underperformed relative to gold here on both of the last rallies in gold. So you saw in April that when gold was trading around 123, the miners were trading around just under 25, between 24 and 25. In June, when gold made that same rally, we peaked out between 23.5 and 24 at 23.86. Right now, we're testing those levels again, and we're still only trading 23.15. Gold miners are played a little bit because of the leverage that they provide in addition to gold. So when people are looking for a leveraged long in gold, they go into the miners or the junior miners. The junior miners have underperformed similarly. I'm not going to go onto the chart there. What I do like about the miners here is the volatility level. So first I'm going to look at gold on the chart. We already knew that on the underlying, it's bumping up against resistance with the potential for a breakout. And volatility is really trading near these highs other than the last, the time when we rallied way up there into the 123s in April, the vol got up to 16%. That's very much possible. Again, we could jump from 12 to 16, but we're trading at the high vol we saw in May as well. Let's go to the miners. We're still trading way low in the volatility here in the miners. June vol, when we spiked, was sitting around 29%. April vol, when we spiked, was sitting around 36%. This move brought us all the way from 24 to 25%. Remember, the VIX moved from 10 to 15, the 50% rally in the equity market volatility. In GLD, the volatility rallied from 10% to 12%. At least it was 20% increase in volatility. In GDX, we only got 1 point this week, and we didn't get the full follow through in the underlying. If people want to get leveraged long in gold, and they start going into GDX and press us towards 24 or 25, and volatility is this cheap, we can make some serious dough. I'm going to clear these vols here. Let's look at what that means right now. So right now, on the August 18th, these vols update with the time to expiration. So with a little bit of decay, these will drop down. But we're talking about 24% for this week versus 24.5, 25.5 range. So August 18th, this week's expiry is trading at a discount to the next few weeks. What did we see in the major indices? SPY this upcoming week is really at a premium generally, or at least flat. So if I want to play something here for a breakout and move towards 24, I think we can do that. We can look at these 23.5s for 16, 17 cents. They'll probably be a little bit cheaper if gold doesn't rally on the open. 24s, 6, 7 cents. I have bought a few of these myself. I am long both the 23.5s and 24s in full disclosure. If we get that explosion out in GLD and that breaks out, the miners are going to have to play catch up, and they could do it fast, and the volatility could come up fast. What I really need to make sure on for me is I'm playing this more on a gamma basis. I'm now looking towards September. I think that September is where you want to be focusing your efforts if you think that this is a sustained rally in the risk-off asset, because the volatility increase from 25 to say 32% could create a very explosive payoffs for some September options. Those September 25s at 27%. If I modify this volatility to 32%, those appreciate in value by 50% from 19 to 28. Similarly, the 26 calls 28.5%. Let's assume those go to 32. Let's go from 8 to 13. More than 50% of the value increased simply off of volatility. You get delta benefit as well. Let's say you get a $1 rally and then a move to 32 vol. These 26s are probably trading about 28 cents. That's an amazing return for a 9-cent option to have a potential to triple on a $1 move in the gold miners. A $1 move is about 4%. Implied volatility says that an expected daily move right now is 1.5%, and if we get that vol spike, it's closer to 2%. You could have a 4% move in a week very easily. So it's something we got to be aware of. I really like the gold miners here. This is one of my favorite little plays. It's on the same note. TLT has a very similar setup to me as the gold miners. We rallied up to 120. What was it? 128.57 in June when bonds were rallying. We've reduced the probability of a Fed rate hike in September to 0. December, I believe it was around 40%. Last I checked. If things escalate with North Korea, interest rates aren't going to go up anytime soon, and TLT will. So you could see us easily trading back above 128. You could see us easily trading above 130. If there's a real panic in this market because something going on in North Korea, you've got some good upside here. And so the reason, though, that I really like this TLT is, again, because of the option volatility setup we've got. The volatility is trading right here in kind of an average level, 10.5-ish%. April, 14%. So you can get 3 or 4% out of this into a rally. And that's why I'm looking at September here again. This also includes the next non-farm payroll data, so there's a lot of really good benefits to September. You look into these 129s. This is not just looking to profit off of the move in the underlying. You're also expecting a vol bid. That's why you want to look at something like the 129s. If we rally from 126.5 to 128 and vol increases from 11 to 13, you actually want to be slightly out of the money. Traditionally, you want to go through your long strike, but when I'm looking for something with a big vol bid, I actually really like going almost right to my long strike. So 128s or 129s here would be a really cool play. 129s for me a little bit better just because you get a little bit more leverage out of that play on a move to 128. I'm not going to get into the nuance of it. It's just the little bit further out of the money gives you a little bit more leverage. So I do like the TLT Septembers. If I'm looking at something very quick and short dated, I'm looking at the August 127.5s. That's just for this week. You got to get movement quickly because we're really expecting only about a 0.75% move per day, or for the week, call it 3.5%, which, sorry, 0.75% per day, or for the week it would be like 1.5%, maybe 2%. So your max kind of move would be up to 129. So you want to go a little bit closer to that money. That would be on a sort of a panic thing. I would think 129 is within reason, just on standard deviations and on what we saw on the charts there. So TLT, 2 possible plays here. If you're looking for something quick this week, you look up the just outside on the 127.5s. If you want to make sure that you have a little bit more time, I actually like the September a little bit better because if we get that quick move this week, these get paid both on vol and delta. And you don't have to worry about your imminent beta destroying your option premium. You know, you pay 70 cents for these instead of 36 cents for the August 127.5s. And on a rally to 129, you're going to get paid really well. So yes, the August will pay you more on a rally to 129, but if we only rally to 127.5 or 128, then the September is actually where you're going to have been better off. So I like getting a little bit more time because vol is cheap. Last 2 for you. EWY. This is, of course, one of the more natural plays on the North Korean situation. South Korea is in a little bit of panic mode right now. We've pulled back from highs and are now playing around at the 100-day moving average. Here's what I like to see on this, and it's actually sort of what I'm thinking may probably happen in all of the indices this week, is if we just kind of chop around. When we broke to the 50-day, or sorry, we'll go sort of one at a time. We broke to the 20-day moving average and just kind of chopped around it for 4 days. We broke to the 50-day moving average and chopped around it for 4 days. Now we've broken to the 100-day moving average. So Monday, Tuesday, if we follow the same pattern, we're still chopping around the 66 level. Things change with North Korea. Obviously, that creates a catalyst. On the upside, I don't think we're going to have such a great fix to North Korea if it happens this week that puts us to new all-time highs. So maybe 70 is your high, maybe really only 68. You're not going to have, I don't think, a massive explosion. On the downside, obviously, if things get bad, they get real bad. If things don't change, what pulls us away from this level, though? And what's most likely, honestly? Are we going to get massive change in the North Korean situation? It seems like we've just had a little bit of jabbing back and forth where, they say, don't shoot at me, and then we say, don't shoot at me, but if you shoot at me, I'm going to do this or I'm going to do that. So I actually do think that we could have a couple of days of sideways action. That's what starts getting the vol down, VIX down. Maybe the S&Ps and some of the normal sectors bounce a little bit, but I don't think South Korea is going to move too much. And if that does happen, where we say stay between 66 and 67, the interesting play here is a little bit more complicated. I'm looking at a butterfly. I'll show you why. So again, there's the underlying. Let's go to the vol. The volatility here has spiked. This is a 16 vol product. It's jumped to 26. This is very similar to what we saw in other indices where we had the move from 10 to 15. Here we went from 16 to 26. So a very similar 50-60% increase in the vol premium. But realized vol went from 15 or 16 up to 16.5. So yes, we did have a break. Yes, there is a lot to worry about in terms of tail risk. But do I really think we're going to get a huge move this week? I just said I didn't. This is a spot where I like collecting a little bit of premium. I'm not going to do it in an unconstrained way, though. You don't just go out now and say, I'm going to sell a bunch of straddles, because if either nuclear war comes out, well, nuclear war, it doesn't matter what you did, everything goes to zero because the world is over. But if we have some sort of major acceleration in the problem, a missile gets fired and shot out of the sky, something like that, then South Korea is going to get in trouble and we could have a spike down, and I don't want to have that tail risk of just a naked short option. What I do like as a really interesting R&R is a complex trade. I can't pull out my complex right now. But what I'm looking at is the 64, 66, 68 call butterfly. So if I look at this, the 64, 66, 68 call butterfly would be long one of the 64s, short two of the 66s, and long one of the 68s. 226, so 260 minus 113 two times, so 260 minus 226 is 34 cents, plus 28 is 62. So you'd be looking to pay 62 cents for something that's max value is $2 if we pin at 66 on Friday. But if volatility changes simply from current mid-markets down to historical vol, let's take the little bit shorter dated, say 20%. Let's type in 20. 20 there, 20 there, 20 there. Obviously there's some skew, there's some other stuff here. But I'm long this one. This is going to have the most skew benefit. But if vol goes down to 20%, or we have a little bit of passage of time, or however you want to look at this, vol decreasing in a short-dated option is very similar to time passing. But anyway, if vol decreases to 20%, 209 minus 63 minus 63 again, so that's 126, and now we're up to 83 cents. Plus 8 is 91. So that butterfly can increase in value by 50% from a simple short time passage of time. It's a pretty good R&R trade. Volatility goes nuts, goes to 60. You're going to get hit, obviously, but you have theta on your side. So if we go nuts, if volatility goes nuts, but we don't move, you're still going to end up okay on this. Where you get into potential trouble is if the market moves a lot, say down to 60 cents, you're going to lose the premium you paid. There's still going to be a bit of a vol bid, so there's going to be some money left in that you can try to salvage, but just assume that you're not going to be very happy if we do have something really, the tensions really get worse in South Korea. Again, I'm thinking right now that we're not going to want to increase the tension there, and that's going to create a little bit of chop in South Korea for at least the beginning part of the week until maybe something changes at the end of the week, like it always seems to happen closer to Thursday and Friday. So if you put on this butterfly in the range of 60 to 65 cents and get out of it in the 90 to $1 range, I think that's a really good R&R trade for something that's generally a little bit lower risk. So that's how I'm looking at playing potentially South Korea. That's the only way I'll play the Korea situation through the South Korean ETF. There has been some big vol flow. Like in October, people were buying the 64.60 put spread and selling the 70 call. I think that's pretty intelligent because you do that at close to zero cost. Are we really going to get above 70 without de-escalation of tensions? Probably not. If we break, they're going to make $4 on the put spread. I don't think I would do it with a put spread, but because of where volatility is, you kind of have to do it with a put spread instead of with an outright put. So into a rally, if volatility gets low enough, then you want to look at this as an outright put, but you got to get vol back below 20%, and that probably doesn't happen unless the North Korean situation gets resolved. So it's, for people looking for an outright long put in South Korea, you probably missed it already. So you got to wait for something else to change. If you want to play for the Korean situation getting worse, you're probably not going to do it through this ETF, because the volatility is going to come down in S&Ps and the Nasdaq and everything else, where you're going to have a better R&R if tensions escalate later on. Finally, XLF. So we talked a little bit earlier about TLT. So let's remind ourselves what's going on with TLT. So in TLT, bond yields dropping, interest rates dropping, and everybody knows, because everybody on TV always talks about, if interest rates drop, it's bad for the banks. So we've got a situation where XLF made a new 52-week high, and last week I was talking about if you could get below 25.30, then maybe you start looking at some puts. I bought a couple of August 25 puts when we were trading around here. We did break through, so that was a nice trade. And now we came right down to the 50-day moving average, and we've got a big inflection point to decide upon, just like we've seen in some of the other big indexes. These moving averages, because so much trading is algorithmically based, they really matter. These algorithms use them as an input. That's why they matter. They, for somebody looking at stock without looking at, if you didn't put the 50-day moving average on your chart, you wouldn't say that this price matters. But once you see the way that markets react around these key moving averages, you start to recognize that that's one of the inputs that the computers do likely use. And since the environment we're in is a very computer-driven market, when everybody's trading correlations and everybody's trading risk parity and all that other stuff, these numbers matter. So the key to me is, if we break below the 50-day moving average and close below the 52-day moving average, then I'm targeting a move to the 100-day moving average. It's not that hard. Get below 24.65 and we go to a little over 24 at 24.10. If the 50-day moving average holds, we probably bounce back up towards 25. It's not an exciting trade to play for 20 cents of upside. Maybe playing for 50 cents of downside, you can get a little bit of money out of this in a short-dated option. So let's look back at the August. Well, volatility's come up a bit. 25s are 16 vol. You can see that in vol, it's pretty close to the recent highs. Vol might get up to 20%. And these 24s are already 24%. 24.5s are already 19%. So for me to play for a move from 24.60 all the way down to 24.10, it's really not that profitable to do it in a 24.5 put outright. But if I can do the put spread or the put 1x2, check your margin. That's interesting, because now I can buy this put spread for 7 cents with potential payout of 7 going into the 35 or 40 range. That's 5, 6 to 1 on a put spread. That seems pretty good. If I could buy the put 1x2 for 2 cents, that's a great R&R. The risk, of course, is now that move back all the way below 23.5. That's a pretty big break for this week. Wouldn't put the 1x2 on any sort of meaningful size, only because I don't know if something's going to happen in the world that does drop us below 23.5. $1 is a lot, and it's also not a lot. At a 16% implied volatility, one standard deviation for the week is a little over 2%, aka about 50 cents. 2 standard deviations is about $1. So if we have a 2 standard deviation move this week, that gets us right down there to pretty close to 23.5, a little bit above, obviously, because we're at 24.75 right now. But beside the point, that's not crazy to think that we could get down that low. So for me, I think you can play this with the put spread very easily. The put 1x2 would be an interesting play if you were looking for something very small, very defined risk. But on a close below 24.65, I'll go with the outright put spread. If I was trying to get ahead of it a little bit, maybe I do the put 1x2, and then on a close below, I turn it back into a put spread. So For me, though, this trade is definitely on the put spread side. With volatility having increased across the board, I'm less inclined to look at a lot of long outright options in general, outside of that GDX trade, just because volatility there didn't increase. So that's pretty much it for what we've got today. We'll kind of recap here. We broke a lot of key levels here. We're testing some big moving averages in the S&P, Qs, IWM, Dow Jones. VIX is very elevated. The volatility of VIX is very elevated. USD, the dollar yen is continuing to break. That's creating a really good support for gold. That creates our interesting opportunity in the gold miners, where I can get leveraged long gold with option volatility cheap. So I'm getting cheap leverage on leverage. It creates this great explosive sort of setup for me that I really like. TLT very similar. Leverage on TLT is relatively cheap. And if interest rates continue to decline because of macroeconomic concerns, this could have a very nice upside potential with volatility increasing. Better play to me to buy TLT calls than to buy SPY puts for that reason, only because the volatility has a little bit more upside in TLT than in SPY. And so it's not necessarily that you're going to make more money in the case of a macroeconomic downfall, but it's more that you'll have a better R&R, where if the market does kind of stabilize a little bit, you lose a lot less money here than you lose here buying puts. So that's why I kind of like buying calls there. It's a better defined risk setup there. EWY, I like that butterfly for some stabilization to start the week. And again, XLF, I'm looking at put spreads there. So we're looking at a lot of things that are generally on the bear side again, and this is because of this elevated volatility. If the vol of volatility comes down enough, I do want to look at some put spreads in the VIX, because that would mean to me that if the market starts to recover, this is an interesting play to be short VXX again, go back into that favored trade. But at current vol levels, I can't do it, and I'm not going to play long volatility for anything bullish right now. You either have to sell a put spread, like I mentioned, which is, it's a good thing to have on it as a bullish play. But the more exciting stuff to me is this leverage on leverage that you're getting in GDX. Contact me. Hit up the website, tradeacademy.co. Email me, keith@tradeacademy.co. Call me, 312-600-8004, or check me out on Twitter, @tradeacademyco. Thanks again, folks, and I hope you enjoyed this week's Harwood Report.